Hi everyone, thanks for joining us tonight. My name is Simon Barnard. I'm the investment manager of the Smithson Investment Trust. Let me tell you a bit about the trust. We aim to make you money by buying small companies that become big companies. Allow me to repeat that. We buy small companies that become big companies. Primarily, we provide you access to a concentrated portfolio of the world's best compounding small and mid-sized companies. Now, there are a few unique elements to that statement because there are, of course, many small cap managers. But I haven't met many with a portfolio less than 50. So concentrated is relatively unique. And the reason we have the confidence and conviction to build our portfolio with only around 30 names is because we focus on very high quality companies. We focus on companies that we know over time will grow bigger and have a very limited probability of going wrong. And that allows us to focus the portfolio on those companies. And why do we think this is a good idea? Well, words from the master himself, Warren Buffett, when he started out, first with this partnership in the early days of Berkshire Hathaway, he had a very concentrated portfolio. And he said, I like to put meaningful amounts of money in just a few things. And more recently, I know he's just stepped down, but when he was asked, what would you do differently now if you were starting again? He would often give the answer, well, it may be that the elephants that Berkshire are forced to buy because they're so big are not as attractive as the mosquitoes that are out there. He would very often say he would prefer to be buying smaller companies. Our strategy is also very, very simple. We buy good companies. What do we mean by good companies? Good companies are those primarily with very strong competitive advantages. Because if a company doesn't have a strong competitive advantage, not only will it not become a big company, it may cease to exist altogether. But alongside that, the indications of good companies would be such metrics as return on invested capital, high gross margins and operating margins, very strong free cash flow, stable balance sheets, and importantly for us, growth, because small companies only become big companies if they grow at a high rate for a long time. So that's exactly what we're looking for. But of course, the best companies in the world can become rotten investments if you don't pay the right price. And for us, don't overpay is therefore the second most important thing we look for when we're trying to buy these companies. And finally, when we found these fantastic companies with a great prospective future, we've not overpaid for them, we try to do as little as possible. And that simply allows these companies to do the heavy lifting for us and compound in value over time. But how do I prove to you that we only buy good companies? Because who would stand in front of you and say they buy terrible companies? Well, for us, we have managed to average all of the metrics from the companies in our portfolio. So the blue bubbles are the average of the companies in the Smithson Investment Trust. The grey bubbles are the average companies in the MSCI SMID Global Index. So this is our reference index. It contains about 5,000 companies. And you can see immediately on the top line, our companies are higher quality. The return on invested capital average is 26%. That is a very high number. And in fact, it doesn't even include our highest return company, which is so high that it skewed the numbers so much I didn't feel it was representative of the average. But you can tell that by the context of the fact that the index on average is 8%. Now, increasingly important, didn't take long to mention tariffs, our gross margins are very high. Now, this is important for two reasons. Recently, for inflation, and our companies have expanded their margins through this inflationary period. But second, the upcoming tariffs. Let me explain why. If our companies have a 62% gross margin, that means they are selling their product for 100, and the gross materials, the raw materials they're using for that cost them 38. For the average company in the index, with a 30% gross margin, it means they're also selling at 100, but their raw materials are costing them 70, almost twice as much as our companies. Now that indicates a couple of things. One, our companies are creating products that are in demand. They have strong competitive advantages which are allowing them pricing power. So they can price far in excess of what it costs them to build their products. So when inflation comes along and inflates their cost base, our companies are only seeing 38 getting inflated, whereas normal companies are seeing 70 getting inflated. And it is quite often the fact that those higher cost-based companies don't have the pricing power to offset that, whereas ours do. So it is a very simple equation for our companies to maintain and expand margins even in inflationary periods, which they have recently demonstrated they can do. When I speak to our companies about the recent policy shifts from Washington, they don't seem particularly afraid. They say 10% tariff is nothing. In fact, they have already passed through what they call surcharges to their customers. The good news for them is everybody in the world knows what's going on. It's very easy to say to their customer, we're only going to put up prices by 5%, but we already know that they've more than covered their increase in cost base. This, of course, leads to higher operating profit margins, and importantly for us, the conversion of cash. We don't particularly care about accounting earnings because they're so easy to manipulate. What we do care is about the cash coming into the business. And our companies, on average, generate 104% of cash relative to net income. And finally, our companies have very strong balance sheets. In fact, they have net cash on average, which means that we couldn't put a leverage number here because it would make no sense. Instead, we used interest cover, and you can see by the size of the bubbles how much more conservatively financed our companies are than the average. But I think the most important number on this slide is probably the bubble on the far right. Last year, our companies grew their free cash flow by 22% on average. That is another big number, and it is an indication that our small companies are becoming bigger companies. So how do we actually run the portfolio day to day? I said it's concentrated. I said there's lots to choose from. So how do we do it? Well, first of all, we start with an enormous universe of about 10,000 companies across the world. But like I said, we are very, very demanding about the quality of the companies that we look at. So what we have been doing since before inception, we spent about a year researching the product. We then launched it in 2018. So we spent about 8 years researching this universe. We have come up with 92 companies that fit the quality that we demand and may one day own. So we watch, follow, and research these companies as if we own them, because on any given day, depending on what the market does, we may well do that. But of course, we don't own 90 companies, we own 32. So how do we do that? Well, there are several different reasons why a company may not be in the portfolio, even though we've identified it as high quality. The primary one, of course, is valuation. It's bleedingly obvious that a good company looks like a good company and everyone can tell it's a good company. You know, this is not rocket science. The difficulty for us, of course, is determining for how long it will be a good company and whether it's getting better or worse. That's the skill. Seeing what it is today is pretty easy. Anyone with pretty basic metrics can tell that, which means that high quality companies tend to be expensive because they are popular. So for us, again, not overpaying is a very significant challenge. And the reason why, even though we've identified 90 names, we focus the portfolio on the 30 that are currently attractively valued. Other reasons why we may not own them is because of business cycle. We don't typically invest in cyclical companies. In fact, we tend to avoid most cyclical companies. We'd never own an autos company, an airline company, anything with highly cyclical earnings. We're scared of it, basically. But some companies do have mild cycles, and it doesn't make sense to us to buy at the peak of their cycle or even as they descend into the trough of their cycle. Of course, life would be perfect if we could buy them just as they started improving, but it's extremely difficult to do. We would simply be happy buying nearer the bottom than the top, which is what we tend to do. Third, and this can be quite exciting, is when a company that we've looked at for a long time goes through a glitch that is just specific to that company and short-term in nature. We've had a couple of examples like this. Our earliest example was in 2018, was Equifax, a US-based consumer credit bureau. And in 2017, they had an enormous data hack, and they lost about 200 million consumer records, which was almost existential for their business. Now, we came along in 2018, and they were just starting to improve their systems, and we made the determination that Equifax was most likely to become the best cyber-secure credit bureau in history after a certain amount of time, and it proved to be. So we managed to get these shares at a significant discount because of their glitch, and they have yet gone from strength to strength over the past 7 years. It has been a great investment for us. And we've gone through more recently something very similar with Clorox. So this is not a particularly exciting company. It is a US-based staples company selling bleach and bin bags, but it is very stable. It's got mid-single-digit growth, which is okay, very much at the low end of what we look at. But the attack was so bad that this is, a company selling a lot of staples consumer products to large supermarkets all around the world, and the cyber attack completely disabled all of their systems, which meant that they were picking, packing, and sending products to Sainsbury's by hand. This was devastating to their short-term earnings, and in fact, it did halve, and so too did the share price. But we, looking at what is underlying stable business, decided that this probably wouldn't last forever, and in fact, it has started to recover. And then finally, there are times, of course, most recently with Liberation Day, when we have enormous market dislocations and everything gets thrown out with the bathwater. So it is our time, we feel, to try and pick up the babies that have been thrown out. And we've got a few examples here. One of my favorites is Rationale, because this is a German-based oven manufacturer. Now, they make the premium professional ovens in the market. There is no better oven than a Rationale oven. They only make professional products. It is the desire of all professional chefs to have a Rationale oven. It essentially is fully automated, so it does all the cooking at the press of one button. They have one installed in the White House. They have one installed in Buckingham Palace. It literally is the reference product. Now, we bought this in April of 2020 when every single restaurant in the world was shut. When better time to buy an oven manufacturer? We bought it about 400 euros. It's now approaching 800 euros. And it is a very high quality company with fantastic products and incredible margins and returns. And we couldn't believe our luck. This is the exposure of the trust. Now, you will notice immediately that we focus in only certain sectors. That is because over time, we have observed that there are only a few sectors that generate strong shareholder returns over the long term. Now, for us, that includes technology, industrials, healthcare, and consumer. And that is where we choose to fish. It also, by dint of looking at only a certain metrics in terms of quality, is the types of companies that we look at. In terms of geography, we are roughly half in the US, 43% in Europe, and somewhat in Asia. Remember, though, we are developed market only. So when I talk about Asia, I talk about Australia, New Zealand, Japan. Let me touch on a couple of companies that you may find interesting. So Oddity, for example, is one that we only bought about 18 months ago. This is a fascinating company because it is taking on the 100-year-old duopoly in the cosmetics market. They are an online-only, direct-to-consumer cosmetics company selling under their own brands, which are Il Makiage and Spoiled Child. And they are able to take on the duopoly, which of course is Estee Lauder and L'Oreal, because they are targeting a white space which they choose not to play in. And that is selling cosmetics to new customers online. That is an extremely difficult thing to do, and is why the two giants have not attempted to do it, because when you sell cosmetics, clearly people want to test it on their skin, see what it feels like, see if it matches their skin tone, and see how they would apply it at home. That is very hard to do online. And it's very expensive if you get it wrong, because when the consumer returns the cosmetic they don't want, It has to be destroyed. You cannot resell cosmetics. So how have Oddity even managed to survive? Well, they did things differently. They started out as a data company. So they now have 40 million consumers on their database who have given them 2 billion data points. Now, this has created essentially a platform, and we've used it, I've used it, my wife's used it, everyone in our office has used it. You go online, you fill out their quiz, inadvertently provide another 50 data points, and tell them what kind of product you want, and they give you one choice. I say foundation, they give me one option. You either buy it or you don't. And we all know how confusing too many choices can be, so I buy it. We tried it at home, everybody had 100% success. But they tell us that their machine learning algorithms that are feeding this process have got them up to a 90% hit rate, by which, of course, they measure the 10% returns. Now, traditionally, these cosmetics companies would sell via the high street. So Sephora in the US or Boots in the UK. And obviously, most people will go in and browse on their own, but even if you got a consultant, you could have someone help you to choose and apply this cosmetics. And the consultants today only achieve an 80% hit rate. The machines are now beating the humans. And that's why Oddity is growing so fast. The irony, of course, of all of this is that these 100-year-old giants, when we ask them how many consumers do they have on their digital database, they are very proud to tell us they've got nearly 10,000 consumers now. As a reminder, Oddity has 40 million. It's a completely different playing field. Now, are there any names on there that someone would like to hear about? Just shout it out. The Risk. So Risk is a very interesting company. Now, it is placed in the industrial bucket. I caution you, these definitions are given by MSCI GICS. They have almost no bearing on reality. The Risk is an insurance data business, okay? So this has been around a long time. And the reason we like this business so much, and I talked initially about competitive advantage. So the Risk has such a fantastic business model that it connects with all of its insurance clients who feed them the insurance data for free. They then repackage that data within software and analytics and sell it back to their own insurance clients who have given them the data in the first place. It is absolutely fantastic. And because they are connected into every single insurance company, there is no room for another player to do the same. So they are far and away the leader of what they do. And in all honesty, most insurance companies couldn't function without their analytics. They tell them in terms of underwriting the risks that they're taking on. They model disaster damage recovery and repair. They provide pretty much all of the data that insurance companies have to rely on. They are irreplaceable, and it is impossible for anyone to compete with them. Why would you buy small and mid-cap now? Over the past few years, it has been a very difficult market for small and mid-cap, as we've already heard today. This is a relative chart of small and mid-cap relative to large cap. As the line goes up, small cap is outperforming. The last relative trough of small and mid-cap was in the dot-com bubble, which makes sense. That's when large cap was last egregiously expensive. This trend of recovery finished in about 2018, and ever since then, large caps have again been outperforming small caps. I'd say that got a little bit worse from 2022 onwards as we saw the interest rate cycle affecting longer duration assets, which small mid-cap tend to be. But I would say that for the last 6 or so months, things have at least stabilized, if not slightly improved. You can't really see it on such a long-term chart here, but anecdotally, we certainly feel it, and in most people's performance, you can see it. But what this means after all of this time of underperformance over the past 7 years is that valuations are now extremely exciting. So we are almost back. If you see the horizontal line, below the line, small and mid-cap are at a discount relative to large cap, and we are almost back to those days of the dot-com bubble where we see opportunities all around us. If I'm brutally honest, it feels at this moment that there are more opportunities than I have capital. We are constantly finding new, exciting places to put the money. Now, I'm just going to finish with 2 questions, and these are the 2 questions that you should always ask anyone that stands in front of you offering an investment proposal. The first important question is, does it work? Yes, it does work. We have been up in every single year since inception except one, and we are even up in 2025 year to date in a down market. It does work. It is not for everyone. Small and mid cap is volatile asset class. It won't suit everybody's risk profile or appetite. But if there is a portion of your portfolio where you can afford a little more volatility for greater capital growth, then this could be the right decision for you. Now, the second important question, perhaps the most important, is, do you own it? I own a lot of this. So this is my personal investment portfolio. And you can see from this pie chart that over 70% is accounted by Smithson. Now, in case you fear this is a portfolio of only a few £100s, I can assure you that that Smithson holding is worth substantially more than my house. This is a very important investment to me and my family. And I love this quote by Nassim Nicholas Taleb. If you haven't read his books, he's an ex-portfolio manager turned author. All of his books are fantastic. And he has this quote, "Don't tell me what you think, tell me what you have in your portfolio." This is what I have in mind. Thank you. I can take Q&A now.
Thanks, Simon. Oh, question here.
Thank you. You've been telling us how you decide what to buy. How do you decide what to sell?
3 reasons. And some of these are relatively unique to small and mid-cap, because the thing we have to remember about small and mid-cap, particularly founder-led businesses, which we do like, is that small and mid-cap companies can change their direction very quickly. And we've had one example called Masimo. This was a US medical device company, which was still founder-led. And overnight, we literally woke up to discover that the founder had acquired a consumer audio business, totally unrelated to the core business. It eventually transpired that this founder wanted to create, instead of the hospital products that they make, more consumer-focused medical devices, which they wanted to sell through consumer channels like Best Buy and so on, and take on Apple. We thought this was not a great idea for a small US company, so we felt we had to sell out. So there are several instances where it may be the case that a small company changes its spots and we no longer want to own it. That's the first point. The second point, we may make mistakes. It may be the case, and we have made a couple, where the company simply doesn't turn out to have the prospects that we thought that it did. Or perhaps because our companies are smaller, they tend to be in niche geographies or markets. Perhaps that particular geography or market hasn't panned out as we might have hoped. So there have been a couple of examples where we felt we've sold after a mistake. But the third reason is obviously valuation. And we have already discovered a few times that because small and mid-cap have volatile share prices, it is good for us, typically on both ends. It gives us the opportunity to take advantage of glitches, which we have done, but it also means that from time to time, we get our companies simply too expensive to justify. So one example was last year we sold Technology One. This is a company that we had owned for 7 years. It had gone up multiple times, at least 5 times in our ownership, and it had reached a free cash flow yield below 1%. In PE terms, that's probably about 85 times. And we could no longer justify the multiple, even though the company was still firing on all cylinders. And maybe the final point I should mention is that right at the start, our entire aim is to buy small companies that become big companies. We've had a couple that have happened. So Fortinet we bought in 2020. That again went up multiple times, and we sold it at the end of last year because it had reached a market cap of $80 billion. we could no longer justify that as a small company. That had become a large company.
Any more questions? From here?
Do you publish the full list of all 32?
Just wait.
Okay, do you publish the full list of all 32 companies that you have, and what's your gearing of the current portfolio?
We publish the full list in both the full year and interim annual reports. So the latest will have been at the end of December. And there is no gearing on the trust. There never has been any gearing on the trust. It is clearly a board decision. And listening to the board in their discussions, I think it's not something that's necessarily on the horizon either.
And your gearing, oh yeah, you asked him, but what's the short-term view of the prospect of the portfolio with respect? Are you doing anything with green issues or AI issues to ready yourself for those?
In terms of exposure to AI? Or?
Exposure to AI, do you explicitly look at the AI in your shares, or green issues, or even Trump issues, if you like?
Oh, I mean, we look at the good news about having only 30 companies is we know them so intimately and we speak to them so frequently. We are constantly thinking, talking, and looking at these issues. In terms of AI, I mean, we have some exposure to AI, yes. So we have a company called Vertiv, which is the leading provider of customized liquid cooling for AI data centers. That's growing quite quickly, as you might imagine. This is a company that's growing revenue at 24% a year, and yet has very strong margins, mid-teens margins, and is only on a free cash flow yield of about 3%, PE terms about 25 times when we bought it a few months ago. So that is a very exciting company for us. One other exposure we have, which is slightly different, is we spend a lot of time looking for companies. We are so demanding in what we want that there are so few, it takes all of our time just to search for these companies. So over the last 8 years, we've had a myriad of different ways of looking for these companies. Initially, we started out just with financial screens, but after a few years, you realize you basically see everything you've seen before. So more recently, we have focused on certain growth themes. Of course, AI is one of them. But at the time we were doing this, 18 months ago, it was just building up to this AI boom and everything was feeling quite expensive. So Vertiv, for example, was way beyond the valuation that we would have liked. It's only that it halved in price over the last 6 months that we even got a chance to buy it. Again, it goes back to that 90 companies that we're following, and one day we just step into it when the valuation's right. But when we were doing this and couldn't find anything AI related that was attractively valued, we were looking for other avenues. And one which we found was called Reply. This is an Italian company, which is an IT consultant. And we like it for two reasons. One, it is has very many blue chip customers. So they, while being a small company, they have very large customers which keep them on retainer, which ultimately is like recurring revenue. I mean, it's not technically because it's not contractual, but it is like having recurring revenue on the one side. And on the other side, they have a buy and build approach. What that means is they're constantly out in the market looking for tiny companies of very specialist software developers and designers that are on the cutting edge of new technology, which currently is AI. So they're constantly buying in these little AI companies, bolting them into their broader group. And so any corporate out there that needs to deploy or design AI systems in their larger corporate group would employ Reply and their specialist software developers to come into their company and deploy this. So they are on the leading edge of AI, even though they are not an AI company, but it's good for them because whoever wins the AI race, and I don't think anyone in this room could possibly guess who it will be, neither could I, it doesn't matter because Reply will just buy up the most relevant company.
Any more questions? I have one. I believe your latest, it's probably a follow-up actually, because I think your latest hire is a tech specialist.
Yes.
Does that mean we should expect more investments in the US or at least more technology type companies to enter the portfolio?
Not necessarily. He happens to be a technology specialist, but we are all generalists.
Right.
He does bring with him a technical expertise that was lacking from the team, but I've already said to him, don't worry, you're not just going to be looking at tech all day, because that's what he's done his entire career. And to be blunt, I think he's looking for a slight change, which we will provide to him. But of course, his opinion on certain technologies will be extremely valuable.
Sure. Thank you. Any more questions? I think time's up. Thank you very much, Sam.
Thank you.